Hello friends, good morning. Now let us discuss. We are in the process of CF&LDT revision, right? In this process, we will comes to the chapter called tax planning, tax evasion, and tax avoidance. So here, tax planning, tax management, tax avoidance, and tax evasion. In this, what is the difference between tax planning, tax avoidance, and tax evasion? Tax planning. Tax planning is a way in which reduction of tax has been taken place by complying with the provisions of the law and taking into account of all the provisions and all the exemptions, all the deductions that are provided under the law, and complying legally. It is a legal way of reducing the tax. This is tax planning. Tax management, tax evasion. Tax management way is the way in which the tax is reduced by following the letter of law but not the spirit of law. That is, it is a way in which the artificially we are creating the artificial means to reduce the amount of tax. And this is a legal way of complying. It is legally allowed, but morally not allowed morally. It is immoral. Next, third one is tax evasion. Tax evasion is nothing but reducing or reduction in the tax by way of misrepresentation or suppression of tax. This is tax evasion. Tax evasion is not at all allowed, and it is illegal way of reducing the amount of tax. This is tax evasion. So there is these are the differences between tax planning, tax management, and tax avoidance. Tax avoidance and tax evasion. Tax evasion. Now, in respect of tax planning, the under PGV, under house property, under salaries, under PGVP, under PGVP, a number of deductions, and number of exemptions, and number of allowances, and number of allowances has been provided in order to plan the tax in such a way that reduce the tax accordingly. Plan the tax and reduce the tax accordingly. This is the way that has been allowed. Now we'll comes to GAAR provisions, that is general anti-avoidance rules. Section 95 deals with GAAR, general anti-avoidance rules. What is GAAR? GAAR is nothing but when the GAAR will be applicable. GAAR will be applicable when there is an arrangement between the parties that leads to impermissible avoidance agreement. Section 96 deals with what is impermissible avoidance agreement. What is impermissible avoidance agreement? Impermissible avoidance agreement is an arrangement between the parties that have two objects. First one is the main object is to reduce the tax, to obtain the tax benefit or to reduce the tax, and second one is to satisfy any one of the following conditions. There are 4 conditions that have been prescribed. This is tainted conditions. Any one of the condition has been satisfied, then in that situation we can say that it is impermissible avoidance agreement. What are those conditions? First condition is what? First condition is revision of amount of tax. What is first condition? There are totally 4 conditions that have been prescribed, right? First condition is yes, wait. Yeah. We are the four conditions, right? There are 4 conditions that will any one of the conditions need to be satisfied in order to be an impermissible avoidance agreement. First condition is creating an arrangement or obligations between the parties which would not ordinarily arise if the parties have entered into an arrangement at an arm's length price. This is first condition. Second condition is what? Second condition is if the main object of the transaction arrangement is to reduce the amount of tax or to obtain the tax benefit either directly or indirectly. And third one is to lacks commercial substance or deemed to lack, the arrangement lacks commercial substance or deemed to lack commercial substance. And fourth one is entered into manner which is not ordinarily employable or ordinarily employed for bona fide purposes. This is fourth condition. If any one of the following conditions are satisfied, satisfied. That is first one is the obligations, rights and obligations arranges between the parties that would not ordinarily arise in when the transaction is undertaken at arm's length price. Second one is it is directly abuse of provisions of the law, abuse or misuse of provisions of the law. Second one. Third one is it lacks commercial substance or deemed to lack commercial substance. Fourth one is entered into in such a manner that would not ordinarily employed in the normal course of business. These are four conditions. So here it lack commercial substance or deemed to lack commercial substance has been defined under section 97. So section 97 deals with this one. What is section 97? Section 97 says here when the transaction is said to be lacked commercial substance or deemed to lack commercial substance is when elements of when the transaction is said to have lacked commercial substance is deemed to lack commercial substance is in respect of substance over form. When the substance of the transaction is different from that of the part or any step or part of the form of the transaction, that is inconsistent or differs from the form of the any step of the transaction or any part of the transaction, then it will lack or deemed to lack commercial substance. Second one is the arrangement of the transaction includes round tripping of funds or accommodating party. What is round tripping of funds? Round tripping of funds means here the funds are transferred between the parties in such a manner to obtain the tax benefit. To obtain the main object of the transactions are to obtain the tax benefit. It is series of transactions and where the source of source from which where the source of the fund is not easily known, from which the fund has arisen or received is not easily known. This is round tripping of funds. Second one is accommodating party. Accommodating party is the party who has entered into an arrangement. The main purpose of the party is to obtain the tax benefit for the purpose of obtaining the tax benefit, where he is a connected person. What is the meaning of connected person? Connected person means in respect of individual, his relative, or any individual, his relative or any person who is having substantial interest in the entity. So substantial interest means more than or equal to at least 20% of the income should be derived from the entity, then it is said to have substantial interest. Now HUF. In case of HUF, members of the HUF or relatives of the members of the HUF is said to have be related connected persons. Next, third one is in respect of partnership firm. In respect of partnership firm, partnership firm, association of persons or body of individuals. Partners are members of the firm. Any firm that is having substantial interest in in any of the entities, and any relative of the partners or members of the firm is said to be related connected persons. In respect of a company, any director of the company, any relative of the director of the company is said to be related persons or connected persons. Next, in respect of a company, firm, association of persons, body of individuals or HUF who is having substantial interest in the entity, or any director or members or partners or relatives of the director, member or partners, or a company, firm or association of persons, body of individuals or HUF where that the directors or members or partners or relatives of directors or members or partners is said to have substantial interest, or a person who is carrying on business and he is having substantial interest in the company, firm or person, association of persons or body of individuals or HUF, or any director or member or partners of the firm association of persons or body of individuals or any relative of the firm, director or partner or members. These are said to be connected persons. Next, in respect of if the transaction involves accommodating party, then it is said to have the lack commercial substance or deemed to lack commercial substance. And third one is Third one is the transaction which disguises the sources of the transaction which disguises the source of source location source transaction or location of the asset, control of the fund, value of the value location, owner the source and control of the fund or the transaction in such a manner that it is in the form of cancelling of transactions or cancelling or rearrangement of transactions, cancelling each other. It is in this manner of cancelling each other, or location of the asset, or ownership of the control of the transaction or place of the residence without having any substantial commercial purposes. But the main purpose is what? Main purpose is to obtain tax benefit. If in all these situations, it is the transaction is said to have lack commercial substance or deemed to lack commercial substance. Now we will discuss about section 97. Section 97 we have already discussed. That is section 96 is lack commercial substance or deemed to lack commercial substance. Section 97 what it tells? Section 97 we have already discussed. Next, what are the consequences of arrangement of impermissible avoidance agreement? What are the consequences? Consequences are denial of tax benefit or tax benefit under the double taxation avoidance agreement. First thing. Second thing is what? Disregarding or combining or rejoining and recharacterizing any step or part of the step of the transaction. Next, transaction of impermissible avoidance agreement is disregarded or not entered into. Disregarding the accommodating party, obviously disregarding our accommodating party, and deeming the connected persons as to be one. Reallocating of accrual of receipt of capital or revenue or expense or relief or rebate. Treating the place of residence or person or treating the place of residence or place of the asset or person has to be one. Looking at the arrangement, disregarding the corporate structure, recharacterizing the debt as equity or equity as debt or vice versa. Next, recharacterizing the expense or revenue expenditure as capital expenditure as revenue expenditure or vice versa. So now these are all the consequences of impermissible avoidance agreement, applying of GAAR provisions. That is arrangement. The consequence of the arrangement is an impermissible avoidance agreement. These are the consequences. Now we will discuss about what we have discussed when the GAAR will be applicable. GAAR will be applicable only when the tax benefit is exceeding 3 crore rupees. 3 crore rupees, then only GAAR will be applicable. If it is less than or equal to 3 crore rupees, GAAR will not be applicable. And GAAR and SAR will coexist with each other. GAAR shall not apply in case of tax planning. In case of tax planning, GAAR shall apply only in cases of tax avoidance or arrangement. Tax avoidance arrangement or only in case of tax evasion. GAAR will not apply in case of tax evasion. So GAAR shall not applicable in case of tax planning arrangements, but only tax avoidance arrangements. Tax avoiding arrangements GAAR will be applicable. GAAR shall not be applicable in case of tax planning, and GAAR will not be applicable in case of tax evasion arrangements. Tests of tax planning. There are two tests of tax planning. That is tax planning. Those are flexibility and complying with law. And types of tax planning are short range tax planning and long range tax planning. Tax planning in diversion of income and application of income. There are two separate concepts. What is diversion of income? Diversion of income is diverting the income from the source itself to other entity, so that the income has not arisen and it will not come under the total income of the person, is diversion of income. Application of income is the income will be included in the total income of the person, and it will be applied as per the wish of the person. This is the application of income. So these are the GAAR provisions, general anti-avoidance rules. Now we will discuss about, we will comes to deductions. Some of the exemptions that have been provided and incomes which do not form part of total income, that is exemptions that have been provided under the Income Tax Act. What are the exemptions are specified in the section 10. Section 10 subsection 1 deals with what agricultural income. Any income arising from the agriculture is allowed as exempt. These are divided into two categories. Agricultural income come from the doing of agriculture in domestic countries in India, or any income that has been arisen from agriculture by doing outside India. Income arising from agricultural activities in India is exempt. Income arising from agricultural activities outside India is taxable, fully taxable, and even in the article Constitution itself, there is no article that will tax the agricultural income. So agricultural income is exempt. And what is agricultural income? Agricultural income is income arising from agricultural activities. What is agricultural activities? Agricultural activities are activities relating to activities that are connected with growing of crops, that are connected with land. All these are considered as agricultural activities. And any here there is a rule that will be rule 7, rule 7A, rule 8 have been prescribed here, where the activities involved, so partly agricultural income and partly agricultural activities and partly non-agricultural activities. Then income has to be segregated in the following manner. In respect of rubber, in case of rubber business, that is 35% of the income is business income and 65% of the income is agricultural income. In case of coffee business, 40% of the income is business income and 60% of the income is agricultural income. In case of tea business, in case of coffee business, which is manufactured and cured, for 25% of the income is agricultural income, business income, and 75% of the income is agricultural income. In respect of coffee. In respect of coffee beans, which are cured, manufactured, roasted and grounded, then 40% of the income is business income and 60% of the income is agricultural income. This is and here the thing we have to remember is in order to calculate the income tax from agricultural income, non-agricultural income, we have to when there is an agricultural income will be included when the income is exceeding 5,000 rupees, then it will be included, and we have to calculate the tax as per partial integration method. What is partial integration method? In our partial integration method, we have to calculate the tax by taking into account of both agricultural income and non-agricultural income. Once we have calculated the tax, and we are required to calculate the tax on agricultural income plus basic exemption limit, and whatever the tax that comes under step 2 has to be deducted from step 1. Then we will get net amount of tax. On this net amount of tax, we have to add surcharge and rebate under 87 years, surcharge and health and education cess. Then we will get tax on non-agricultural income. This is partial integration method that have been prescribed. Next section, this is section 10, and there are so many exemptions that have been provided under section 10, which is a general list that have been provided. And one of the main important exemption is exemption of profit arising from the units established in special economic zone, section 10AA. Section 10AA, who are eligible to claim deduction under section 10AA or exemption under section 10AA, deduction under section 10AA. The following entities who have units in special economic zone, which are engaged in manufacture of article or production of things and export to other countries, and providing of services, export of services, including computer software related services, are covered under this section. Now, what is the period for which the deduction is allowed, and what is the amount of deduction? Here, for the first 5 assessment years, 100% of the profits is allowed a reduction. For the next 5 assessment years, 50% of the export profits are allowed a reduction. For the next 5 assessment years, 50% of the export profits or amount that has been debited to profit and loss account, credited to export reinvestment allowance reserve, whichever is lower will be allowed as reduction for the next 5 assessment years. So here the one thing you have to remember is what is export profit. Export profit is profit arising from export of articles or things or providing of services or including computer software services is export profit. So how we have to calculate export profit? Export profit is profit arising from the activities carried out in special economic zone by the entities located located in special economic zone into export turnover divided by total turnover. What is included in export turnover? What is excluded in export turnover? Export turnover includes all the receipts, but it does not include any. It does not include three items, that is telecommunication expenses, freight, and insurance charges are not included in export profit. Export turnover, it also not include cash compensatory support. It does not include duty drawback. It does not include cash compensatory support. It does not include duty drawback. It does not include what? It does not include excise rebate, credit, tax credit. Any tax credit that is available, it will not be included. Replenishment of certificates. Replenishment of certificates will not be included. Next, this is not included in export turnover and as well as total turnover also. Total turnover will include the turnover, the receipts that are arising from the activities of sale of goods or provision of services, which are in Indian currency, will be included in total turnover, and domestic currency or Indian currency will be included in total turnover. Now, any receipts or any exchange differences that are arising, foreign exchange differences that are arising but relating to the transactions undertaken in foreign currency, these foreign exchange transactions will not be included in export turnover and total turnover. Then we will get what? We will get export profit. Here some of the ratios that have some of the important points that need to be considered here are if there is any transfer of technical manpower to another unit, then in that situation it will be allowed as in case of computer software related services, software industry, it will be allowed as reduction if any one of the following options have been availed by the company, that is the transfer is up to 50% of the technical man support in the new industry, or it is up to 50% new additional manpower has been employed or taken into account, which is 50% of the total technical manpower in the industry, in the software industry. Then if any one of the following option is satisfied, then whatever then it will be allowed a reduction under 10AA reduction will be available. Next, when we 10 capital A, double capital A reduction will be available, and any transactions that are related to the development of software outside India have been carried out, it will be allowed as reduction. Development of software outside India have been carried out, it will be allowed as a reduction under 10AA, as if the transaction has been it is deemed that transactions have been carried out, and it will be allowed a reduction under 10AA. Now this is any amount that has been withdrawn from the reinvestment allowance reserve, says reinvestment allowance reserve will be deemed to be the income, and investment can be made in second-hand plant and machinery up to 20% of the total plant and machinery of the entity, or any import of plant and machinery considered as new plant and machinery only. Next, new plant and machinery only. Now we will go to what? We will go to deductions that are actual chapter 6A deductions. Before going to chapter 6A deductions, we will go to the charitable and religious trusts. We will complete the pending portion of the charitable and religious trusts. So here first we will comes to from backward onwards. Then we can easily revive properly. Here first we will discuss about exit tax. Exit tax has been prescribed under section 115 TD. What is exit tax? Exit tax is when the charitable trust does not comply with the objects of the when the charitable trust does not comply with the objects of the trust, or when the charitable trust has been converted in a form which is not in a non-eligible form, where the exemption under section 11 and section 12 is not available, or if the is not available, or if the charitable trust has been combined or merged with the another entity which is not liable for registration and not eligible for to obtain registration under section 12AA or 12AB, or if the charitable trust has transferred any of its assets to the non-eligible entity, or if the objects modification of objects has been taken place, then in all these situations exit tax will be applicable. Exit tax will be applicable. What is the exit tax? Exit tax is nothing. Exit tax is applicable. And here, what is the time period? What is the period that has to be considered? The specified date in respect of different transactions is different. First one is in respect of modification of objectives. Then in respect of what? In respect of registration has been cancelled. And appeal has been preferred. Appeal not has been preferred. If the appeal has been preferred, then within a period of 30 days. Within a period of 30 days from the date of receipt of order of the appeal confirming the cancellation of registration or rejecting cancellation of registration or cancellation of approval in respect of appeal has not been preferred, then within a period of 30 days from the date of expiry of appeal period that is applicable for the SSC. Next, in respect of amalgamation and demerger, date of amalgamation or demerger, in respect of the period of 30 days has to be calculated. In respect of what? In respect of amalgamation and demerger, we have seen in respect of modification of the objectives of the entity. Here appeal has been preferred, appeal or not has been preferred. If the appeal has been preferred, obviously we have seen that from the date of passing the order. If the appeal has not been preferred, from the date of expiry of appeal period has to be considered, period has to be calculated, and the SSC is required to pay tax within a period of 14 days from the specified date. 14 days from the specified date that have already discussed in the earlier topics. From that 14 days has to be calculated, and if the tax has not been paid within the due date, then interest at the rate of 1% per month or part of the month has to be levied from the from the day after the due date till the date of payment of tax will be levied. And what is the mode of computation of exit tax? Exit tax is nothing but assets minus liabilities. Assets includes total assets minus total liabilities is exit tax. So what is the rate at which exit tax is leviable? Exit tax is leviable at the rate of 30% of tax plus 12% of surcharge plus 4% of health and education cess. That is 34.944% is effective rate of tax that will be levied on exit tax that will be levied. And here one thing you have to remember, is here assets includes what? Assets includes two types of assets, that is movable assets and immovable assets. In respect of movable assets, we will take what? We will take the fair market value. In respect of mobile property, we will take what? We will take fair market value. How fair market value is determined? Fair market value is determined in respect of jewelry. In respect of jewelry, gold bullion, bullion. Work of art, archaeological collections, drawings, paintings, sculptures. In all these cases, open market value is taken as fair market value. In respect of equity shares, in respect of shares and securities, if the shares are recognized, listed on recognized stock exchange, then average of the share price on the date of listing, date of trading has to be considered. If on the day no trading has been taken place, then the day immediately previous the specified day, average price has to be considered. Average price has to be considered in respect of listed securities. If it is unlisted unquoted shares, in case of unquoted shares, then valuation will be carried out in the form of A plus B plus C plus D minus L into PV divided by PE. That is this is already we have discussed in respect of Rule 11 UA and Section 50 subsection Section 50, subsection 4, unquoted shares, valuation of unquoted shares. What is the process that will be carried out? Same process will be, or section 56, subsection 2, clause 10. What is the process that will be considered? Same process will be considered here also. Or in case of FMV1 in section 50B, section 50B also, section 50B also, slum sale also, this valuation will be applicable. This valuation will be applicable in respect of here the assets does not include what? The assets does not include any tax that has been paid, any tax that has been any tax that income tax that has been paid other than income tax refund. Other than income tax refund, tax includes what? Tax includes deferred TDS and advance tax, and it does not include unamortized amount of unamortized amount of deferred expenses will not be included, and here the thing you have to remember is assets in respect of remaining assets as usual, whatever the value that it will be fetched, fair market value will be included in the total value of assets. Now comes to liabilities. Liabilities includes all the liabilities excluding the following liabilities, that is equity shareholder funds, reserves and surplus, provision for tax, provision for income tax, provision for contingent liabilities, provision for unascertain liability, provision for ascertain liabilities will be allowed as liabilities, provision for unascertain liabilities, and here it does not include what? It does not include tax minus tax refund, tax that is tax that is includes TDS and advance tax minus any refund of tax that has been obtained, and contingent liabilities will not be included in the total value of liabilities. So on the net assets, the tax will be levied at the rate of 34.944%. This is exit tax. Now comes to registration part. Registration part has been prescribed as section 13. Section 13 is what? Section 13 is relating to the ineligibility of section 11 and section 12 will not be applicable in the following cases. Those cases are prescribed under section 13. Section 13 subsection 1, what it will say. Section 13 subsection 1 says if the section 11 and section 12 will not be applicable, if the charitable trust, the section 11 and section 12 will not be applicable if the charitable trust has utilized the funds for the benefit of specified persons. Who are specified persons? Specified persons has been prescribed here. Specified persons are for the benefit of founder or owner of the trust, and all the related or connected persons to him. If the funds have been utilized, then say exemption under section 11 and section 12 will not be available, or if the funds have been invested in the modes other than 11 subsection 5 in that situation also. And if the third one is if the funds have been invested in the modes other than 11 subsection 5, or if the funds has been utilized or transferred to the corpus of another trust or institution, or if the fund is unable to obtain registration under 12AA or 12AB, or if the objects of the trust have been modified, then in that situations section 11 and section 12 is not applicable, or if the income from the business activities exceeding 20% of the total income of the or total receipts of the trust. In that situation also, section 11 exemption under section 11 and section 12 will not be available Next, tax will in respect of if the funds have been utilized for the benefit of specified persons, that is specified persons, or in case of investments that have not been made in the more specified under 11 subsection 5. In all these cases, additional income tax will be levied under section 115 BBI. What is the rate of additional income tax? Additional income tax rate is 30%. 30% of tax rate will be levied. This is additional income tax. additional income tax that will be levied under section 115 BBI. Next, in respect of anonymous donations, here anonymous donation 115 under section 115 BBC, anonymous donations that are religious to wholly and fully charitable trust, that is charitable and religious trust, and that is related to partly charitable trust and partly religious trust. If it is wholly charitable trust or religious trust, any anonymous donation that have been received, then in that situation the anonymous donation that will be up to the limit will not be treated as anonymous donations. It will be taxable at normal rates, and if it exceeds the specified limit, then it will be taxable at the rate of 30%. What is the limit that have been prescribed? Limit is 5% of the total donations or 1 lakh rupees, whichever is higher will be treated as anonymous normal donations. 5% total donations includes anonymous donations plus normal donations plus corpus donations. Here. Next, in respect of partly charitable trust and partly religious trust, here up to the partly charitable trust and partly religious trust, anonymous donation in respect of if the donations has been made to the corpus of the trust, that it shall form part of the corpus of the trust, then they will be considered as anonymous donations, and limit has been prescribed. Other anonymous donations will be exempt. And in respect of wholly religious trust, anonymous donations received will be exempt. It will not be included in total income. And here, what is anonymous donations? Anonymous donations are donations where the record of the person who is donating the amount is not maintained. Then those are called as anonymous donations. Now will comes to registration part. Registration under 12AA, 12AB. This is same. This registration process is same in case of 10 subsection 23C. What is the registration part? Is the registration process that is applicable. Same registration process applicable under in case of 10 subsection 12AA, 12AB. That is validity period of registration is 5 years, and provisional registration will be granted for a period of 3 years. And renewal when on renewing the registration, then again for a period of 5 years, 5 years will be awarded. Registration period of validity of registration period is 5 years. Validity of registration period is 5 years. Now we will discuss about what are the section 11 and section 12. Section 11 and section 12 gives the exemptions relating to exemptions that are available for charitable and religious trust. First we will discuss about section 11. Section 11, what are the incomes that will be included in charitable and religious trust. So here any receipts that are any voluntary contributions will be included in charitable, and any receipts that are arising all the receipts that are arising will be included in income. And any donations that are voluntary donations that have been received other than corpus donations will not be form part of corpus donations will not be included. And any anonymous donations that have been received will be first included, will also be first included. And any other receipts, net of expenditure, first we have to take gross receipts we have to consider here. Next we have to reduce from that 15% of the ad hoc exemption. Then we will get the net remaining 85%. From the net remaining 85%, we have to divide into two parts. First part is expenses which are allowed as reduction, expenses which are not allowed as reduction. Expenses which are allowed as reduction is expenses where expenses which are revenue in nature, and any expenditure that has been incurred, any capital expenditure that has been incurred will be allowed as reduction. And any expenditure that has been made for the charitable and religious trust will be allowed as reduction, or any investment that has been made under 11 subsection 5 modes from the income of the charitable and religious trust will be allowed as reduction. And any expenditure that has been made from the loans or borrowings that have been taken that will be allowed as reduction. Any expenditure that has been made will be allowed as reduction. And here any contribution that has been made or any donation that has been made to other trusts or institutions other than in the form of corpus will be allowed as reduction. And any contributions any contribution that has been made by the charitable and religious trust will be allowed as deduction. All these are allowed as deductions in respect of charitable and religious trust. What are not allowed as deduction? What are the what are not allowed as deduction is any expenditure that has been made where the TDS under section 4 TDS is not deducted, or TDS is deducted but not paid within the due date of return of income, then 30% of the expenditure will be disallowed, and any cash expenditure exceeding 10,000 rupees that have been made will be disallowed. 100% of the expenditure will be disallowed, and any expenditure that has been made to related parties excess of actually related excess of the fair market value will be disallowed, and not allowed deduction. And any depreciation on capital assets on which deduction is 100% is allowed as expenditure, deduction 100% is allowed, it will not be allowed as deduction, and any depreciation will not be allowed as deduction. Next, in respect of any loans and borrowings that have been taken for purchase of assets, these loans and borrowings are not considered as application of income. Any donations that have been made by the charitable and religious trust for the to the corpus of the other trusts or institutions which are registered under 12AA or 12AB, then it will not be included in the total income of the. It will not be allowed as deduction. And obviously we have discussed all the important deductions that are applicable for charitable and religious trust. Now for this income we have to apply income of anonymous donations that are taxable at the rate of 30%. Then we will get total income. So normal income and anonymous donations income. Normal income is taxable at normal rates, that is up to 2,50,000 rupees nil, 2,50,000 rupees to 5 lakh rupees 5%, 5 lakh rupees to 10 lakh rupees 20%, exceeding 10 lakh rupees 30%. And in respect of other anonymous donations, it is taxable at the rate of 30%, and health and education expenses will obviously applicable at the rate of 4% will be applicable. This is related to charitable and religious trusts. This is entirely related to charitable and religious trusts chapter. Now we will go to deductions chapter. Chapter 60 deductions. Here in respect of chapter 60 deductions, for main we will discuss main important deductions. Section ITC is discussed about what? Section ITC discusses about specified investments. Any specified investment that has been made by the SEC during the previous year will be allowed a deduction. Specified investments includes any insurance premium, any insurance policy that has been taken, and insurance premium that has been paid in respect of spouse, in respect of individual and HGF. Limit is 1,50,000 rupees, and it is applicable for individual and HGF, and insurance policy that has been taken for self, spouse or dependent children in respect of HGF, member of the HGF, will be allowed a deduction. When it comes to insurance policy, any maturity proceeds that have been received from the insurance policy will be exempted under 10 section 10D. In order to claim exemption, insurance premium limits has to be satisfied. That is, insurance policy that has been taken before 1/4/2003, or insurance policy has been taken after 1/4/2003 but before 1/4/2012. If the insurance premium that has been paid is up to the limits of actual insurance premium paid, or 20% of the sum assured, whichever is lower, then exemption under 10 section 10D will be available. If the next second one is, if the insurance premium that has been paid, insurance policy that has been taken after 1/4/2012 but before 1/4/2013, and insurance premium that has been paid is up to the limit of actual insurance premium paid, or 15% of sum assured, whichever is lower, then in that situation 10 section 10D exemption is available. In respect of insurance policy that has been taken on or after 1/4/2013, then in that situation there are two cases. First case is the SSC who has who has availed deduction under 80DD, or who is covered under 80DD or 80EU. Then in that category, any insurance policy that has been taken, then if the premium that has been paid is up to the limits of actual insurance premium paid, or 15% of sum assured, whichever is lower, then 10 section 10D will be exemption is available. In respect of other category, then the insurance premium that has been paid is up to 15% up to actual insurance premium that has been paid, or 10% of sum assured, whichever is lower, then in that situation 10 section 10D exemption is available. And any insurance premium that has been received, any insurance majority proceeds that have been received on a key man insurance policy will be taxable in the hands of employer under PGVP. If it is received by the employee, it will be taxable under their salaries. Under 17 section 3, if it is issued by the family members, it will be taxable under the head other sources in the hands of family members. If it is received in the case of death of the person, then in that situation it is entirely exempt. Any income that has been received is entirely exempt. Next, unit linked insurance policy. Whether any amount that has been received under unit linked insurance policy is not taxable under the head capital gains if it satisfies the insurance limits that have been prescribed under ATC and avail deduction under 10 section 10D. If it does not satisfy the limits, if the amount of premium that has been paid is exceeding 2,50,000 rupees, then in that situation capital gain will arise. If the amount is up to 2,50,000 rupees, no capital gain will arise. No capital gain will arise in case of 50B, that is 45 section 1 capital B, that is unit linked insurance premium, and provident fund. In respect to contribution to provident fund is divided into two categories, that is contribution to recognized provident fund, contribution to unrecognized provident fund. Contributions to unrecognized provident fund will not be allowed a deduction. Contributions to recognized provident fund is allowed a deduction. What is recognized provident fund? Recognized provident fund means the provident fund that has been established under the Employee Provident Fund and Miscellaneous Provisions Act 1952, or this provident fund has been exempted under Income Tax Act. That is recognized provident fund, statutory provident fund, recognized provident fund, and public provident fund. Whatever contribution that has been made to these category of provident funds, it will be allowed a reduction under ITC. And any contribution that has been made to superannuation fund is also allowed a reduction. Next, in respect of what? In respect of individual will be having children, right? Children will have school fees. Any payment that has been made in the form of school fees will be allowed a reduction up to the maximum of 2 children. And school fees does not include fees, donations. It does not include donations. Development fees will not be allowed a reduction. And any fees that have been made to private institutes will not be allowed a reduction. Next, obviously, assessee will be having parents, right? Parents, in respect of parents, fixed deposit, they will be making fixed deposits. Any deposit of any amount that has been deposited in fixed deposits of scheduled bank, having the period of 5 years of lock-in, will be allowed a reduction. And any deposit that have been made in post office will be allowed a reduction. Any deposit that have been made in National Savings Certificates Class 8 series will be allowed a reduction. Interest will be allowed as exemption. And obviously assessee will be interested in share market, and he will be investing in mutual funds, and he will be investing in shares and debentures, right? Any investment that has been made in shares and debentures will be allowed a reduction under ITC. Any reduction that has been made under the mutual funds will be allowed a reduction. And obviously assessee will be interested in what? Assessee will be interested in obtaining of building of house, right? He will be obtaining housing loan. Any principal amount that has been paid, principal paid in respect of housing loan will be allowed a reduction, as a reduction. And under section ITC, assessee will be assessee will be having girl child, right? In order to uplift the girl child, so any contribution that has been made to Sukanya Samruddhi Yojana scheme framed by central government will be allowed a reduction under ITC, under section ITC. So these are the specified investments that are given under ITC, where the reduction under ITC will be available at the rate of maximum limit of 1,50,000 rupees. 80CCC, any contribution that has been made to the pension fund framed by the life insurance company or any other insurance companies will be allowed a reduction. The maximum amount of reduction is 1,50,000 rupees. 80CCD is any contribution that has been made to the pension fund of central government or a new pension scheme or Atal Pension Yojana. In this 80CCD, it is divided into 3 categories: 80CCD subsection 1, 80CCD subsection 2, 80CCD subsection 1 capital B, that is 80CCD subsection 1B, 80CCD subsection 1, that is it is applicable for individual only, and any contribution that has been made to the pension fund is allowed a deduction. It is done in two categories, that is actual pension contribution or up to 10% of salary in respect of salaried employees. In respect of non-salaried employees, business persons, it is amount of contribution that has been made to pension scheme or 20% of gross total income will be allowed as whichever is lower will be allowed a reduction. Here salary include basic salary plus dearness allowance, and in respect of additional deduction that is available up to 50,000 rupees, that is contribution to pension scheme under section 80 CCD subsection 1 cap 1b and 80 CCD subsection 2 in respect of contribution that has been made by the employer to the pension scheme of employees. In respect it is related to normal employees, it is related to government employees. It is related to normal employees, it is amount of contribution that has been made or 10% of salary whichever is lower will be allowed a reduction. In respect to government employees, amount of contribution that has been made or 14% of the salary whichever is lower will be allowed a reduction. Here salary includes basic salary plus dearness allowance. Basic salary plus dearness allowance. This is 80 CCD subsection 80 CCD. Now 80 CCE, that is any deduction that is available under 80 C, 80 triple C, 80 CCD, which to the maximum extent up to 1,50,000 rupees will be allowed a reduction under 80 CCE. Next we will discuss about 80D. 80D is related to what? 80D is related to medical expenditure that has been incurred by the SEC will be allowed a reduction. Here it is related to two categories, that is any medical expenditure, medical insurance premium that has been paid will be allowed a reduction. It is related to two categories. First one is in relation to assessee self, in relation to parents. In relation to assessee self plus spouse plus dependent children, any insurance policy, any premium that has been paid for medical insurance policy will be allowed a reduction to the maximum extent of 25,000 rupees. The premium has to be paid. And second one is in respect of this is in respect of parents. In respect of parents, any medical insurance premium that has been paid for the parents, it will be allowed a reduction to the maximum extent of 25,000 rupees, and 25,000 rupees it will be allowed a reduction. And here another thing you have to remember is any medical expenditure that has been incurred by the SSC, it will be allowed a reduction to the maximum of 50,000 rupees. And if the parents are senior citizens, and higher limit of 50,000 rupees is available in respect of medical insurance premium that has been paid. And medical insurance premium plus medical expenditure that has been incurred in respect of parents cannot exceed 50,000 rupees. So it should be maximum of 50,000 rupees only, it will be allowed a reduction. In respect of medical insurance premium that has been paid in respect of self plus in respect of self plus parents, is the parents are senior citizens, so maximum medical expenditure that has been medical insurance premium that is allowed a reduction is 50,000 rupees only. 50,000 rupees only. 50,000 rupees only. Next, in respect of any expenditure that has been incurred in the form of preventive health checkup will be allowed a reduction to the maximum of 5,000 rupees. 5,000 rupees. Here one thing you have to remember is the expenditure relating to preventive health checkup can be paid in the form of cash, or it is other than cash. But in respect of medical insurance premium, the amount of expenditure that has to be incurred in the form of other than cash, that is by way of account pay check or account pay demand after electronic clearing system through bank account or any other electronic mode, then now this is 80D, and it is applicable for individual as well as HUF, and limit is obviously we have seen limit 25,000 rupees or 50,000 rupees as the case may be. And 80. Now we will discuss about 80DD. 80DD is any expenditure that has been incurred on maintenance of handicapped disabled person or disabled person or a handicapped person. Here it is applicable for individual only. Amount of reduction that is available is normal disability. It is it is 75,000 rupees. Severe disability, amount of reduction is 1,25,000 rupees. 1,25,000 rupees. Is allowed a reduction. So this is now the remaining reductions we will discuss in later sessions of the class, later sessions. Okay, thank you for patience listening. Bye.